We are so back. Hey everyone, today we're going to be doing video number 4 of the SIE exam series. Today's video is going to cover debt securities, understanding different products in the financial world as well as their risk. This is going to be 44% of the SIE exam. Last time we talked about stocks. Remember, this is not financial advice. This is for your education only. Now, let's see what we're going to cover in today's video. We're going to be looking at bonds, the different types of bonds, how bonds are priced, and what yield means, the price versus the bonds yield relationship, the rating system for bonds and how they are rated, the money market instruments, as well as the risk that comes with bonds. All right, first, let's look at bond basics. A bond is essentially an IOU debt instrument. When you buy a bond, you are lending money to the issuer, whether that be the government or a corporation. In return, the issuer of the bond promises, hey, I'm going to pay you back at a later date, plus interest, and they will return your principal at the maturity date. Let's look at the different parts of a bond. We got par value, which is the face value of a bond. Typically, it's represented as $1,000. This is the amount the issuer pays at maturity, also called face value or the principal. Coupon rate. The coupon rate is the annual interest rate that is paid on a bond's par value. At 5% coupon, the bond pays $50 per year, which $25 semi-annually. Most bonds pay semi-annually. Maturity date is the date on which the issuer repays the par value back to the bondholder. The bond can be a short-term, 2-year bond, intermediate, 2 to 10 year, or a long-term, greater than 10-year bond. Market price. The market price is what the bond actually trades for on the secondary market. This may be above or below the par value. Before we move on with the video, we have a quick word from this video's sponsor. If you are one of those people who are trying to step up their productivity game, I would recommend checking out Cowork by Anthropic. I've been given the privilege of being able to present to you an affiliate link down in the description below. The first 3 people to sign up with the affiliate link will get 7 days of free Claude Premium. And anybody who subscribes to Claude using the affiliate link will be supporting my channel directly, which means a lot. So if you're one of those people who's trying to automate the everyday boring task or to help them prepare and brainstorm for their next big project, I would absolutely recommend Claude down below in the description. With that being said, thank you so much to Anthropic for even giving me the chance to present this offer to you. And with that, back to the video. Let's talk about types of bonds. We got US Treasury bonds, which is example T-bills. This is seen as one of the most secure and one of the safest investments, which is bonds issued by the US federal government, backed by the full faith and credit of the US government. Interest is subject to federal tax, but it is exempt from state and local taxes. Next, municipal bonds. These are local government bonds, issued by states, cities, as well as local government. Interest is usually exempt from federal income tax and often from state/local tax as well. This is popular for high income investors. Corporate bonds. These are a little bit more risky than federal bonds, but they're issued by a corporation in order to raise capital. They have a higher yield than government bond, but it also does have a higher risk. It is taxable at all levels, federal and local. Agency bonds. Agency bonds are issued by government-sponsored enterprises. Think FHLB. These are not directly backed by the US Treasury, but they are considered very safe. The yields are slightly above Treasury bonds. Zero coupon bonds. These bonds pay no periodic interest. They're issued at a deep discount to par, and they are redeemed at the full face value at maturity. The difference is taxable at interest income annually, which is phantom income. Next, let's look at bond pricing as well as yield. Nominal yield is the coupon rate on the bond. A bond with a 6% coupon has a 6% nominal yield. This never changed. It's fixed at issuance, and it's also called the coupon yield. Current yield. Annual coupon payment divided by the current market price. If a $1,000 bond with a $60 coupon trades at $900 par value, the current yield is equal to $60 divided by $900, which is 6.67%. Yield to maturity. This is the most important yield. This is the total amount the bond actually returns to you if it is held until maturity. This accounts for the coupon payments as well as any gain/loss from buying at a discount or premium. This is what investors really care about. When a bond trades at a discount, the nominal yield will always be lower than the current yield, and the current yield will always be lower than the yield to maturity. Again, it's true if the bond is, it's true in the opposite direction if it is at trading at a premium. All right, let's talk about the price to yield relationship. Again, bonds and the price of bonds and the interest rate have a inverse relationship, meaning if the rates rise, newly issued bonds offer a higher coupon payment, which makes existing bonds less attractive, meaning that the existing bonds price continues to fall. If the rates fall, the newer issued bonds don't look as attractive as the old ones, which drives the price of the old bonds up. Again, trading at a premium. That's the inverse relationship between interest rates and bonds. Let's talk about bond ratings. Now, how are bonds rated? Think Moody's, think S&P, think Fitch. Again, a lot of people went crazy over the fact that the US government's credit rating was downgraded by Moody's from like AAA to like AA or something like completely random. Like, I don't know. Again, that doesn't really mean too much because historically speaking, the US government has never, ever defaulted on their bonds. But again, that does show the investment risk. Again, you're trying to hit the investment grade bonds. That is the AAA level, low default risk, suitable for conservative investors. And then you also have those high yield junk bonds, kind of like the Klarna pay in 4 payments or the credit card payments, the 2008 mortgage backed securities type of junk bonds that are very high risk, high default rate. Next, let's talk about money market instruments. This is going to cover T-bills, commercial papers, bankers' acceptances, negotiable CDs, and repo agreements. Now, these have varying maturity dates, varying yields, but again, these are going to be considered pretty safe with a maturity of 1 year or less. They are highly liquid, low risk, and they are issued by issuers in order to get short-term financial funding. T-bills is going to be the safest of these. This is backed by the US government. Safest short-term investment, think SGOV. I personally hold SGOV as my T-bill, and I mean, I just use it for safety. There are a bunch of other options that you can look at down below in this video right here. Commercial papers. These are unsecured promissory notes issued only by highly rated firms, exempt from SEC. You got negotiable CDs, which typically come in large denominations, 100K plus. Certificates of deposits can be traded in the secondary market. Next, let's look at bond risks. There are risks to bonds, believe it or not. Yes, bonds are typically seen as the number one safest investment of all time, but that doesn't mean that they are absolutely risk-free. First, let's look at the interest rate risk. If the interest rate rises, the price of the bond will begin to fall. Longer maturity bonds have more interest rate risk than shorter ones do. This is the most important bond risk that you need to know for the SIE exam. Next, reinvestment risk. The risk that coupon payments will need to be reinvested at lower interest rates if the rate falls. Zero coupon bonds eliminate this risk since they pay no coupon payment. Inflation risk. What if the inflation is higher than the return of investment that you get from the bonds? Again, there is a solution for this. You can buy a TIP, which is a treasury inflation protected security. And these are specifically designed to mitigate inflation risk. They also have credit or default risk. Again, US treasuries virtually have no default risk, but If you do buy a bond from a private company or a public company or whatever, whoever else, it does have default risk. Call risk. There is a risk that the issuer of the bond will redeem it early, typically when the interest rate falls. The investor gets the principal back, but they must reinvest the bond at a lower rate. Callable bonds pay higher yields in order to compensate for this risk. Next, there's a little bit of liquidity risk. Again, U.S. government bonds don't really have this liquidity risk, but corporate and municipal bonds do have a liquidity risk. Let's look at what we covered in today's video. In the video, we covered bond basics, types of bonds, bond pricing, as well as yield, price versus yield relationship, bond ratings, and how they are rated, money market instruments, as well as the risk of investing in bonds. As usual with these SIE exam review videos, we're going to be doing a test your knowledge. We have 5 questions of increasing difficulty with answer explanations. All right, let's look at question number 1. An investor purchases a bond with a face value of $1,000 and a 5% annual coupon rate with a 10-year maturity. How much will the investor receive in annual interest payments? Okay, the answer to this question is going to be B, $50, because the coupon rate is applied to the par value of the bond. If the bond pays semi-annually, which most do, that means you are going to be getting $25 every 6 months. The market price has no effect on the coupon payment. Those are fixed at issuance. Question number 2. A bond is rated Ba1 by Moody's. Which of the following best describes this bond? Is it going to be investment grade? Is it going to be junk bond? Or is it not rated? The answer is going to be high yield junk bond. This is below investment grade, which means there's a higher risk of default. Moody's investment grade ends at Baa3. Anything Ba1 or below is considered high yield junk. These bonds typically carry higher default risk, but also must offer higher yield in order to attract investors. Next, let's look at question number 3. A 10-year bond was issued with a 4% coupon when the market rate was 4%. Interest rates in the economy then rise to 6%. What happens to this bond's market price and yield to maturity? Okay, the answer to question 3 is going to be B. The price actually falls and the year to maturity rises above 4%. Remember, the yield and the price of a bond have an inverse relationship, meaning when the market interest rate rises from 4 to 6%, the new issued bond is more attractive to investors. That means the 4% bond is less attractive, meaning that its market price falls. As the price falls, the yield to maturity rises in order to reflect the bond's total return if held to maturity, eventually matching the current market rate of 6%. Price and yield always move in the opposite direction. An investor in the 37% federal tax bracket is comparing a 5% municipal bond to a 7% corporate bond of equivalent credit risk. Assuming the muni interest is exempt from federal tax, which investment provides a higher after-tax return? This one is a little bit difficult, so I'm going to give you a little bit more time to answer the question. The answer to question 4 is going to be B, the municipal bond. 5% tax-free is always worth more than 7% taxable at 37%. I mean, it's just basic math. All right, question number 5. A portfolio manager holds a callable 8% corporate bond purchased at par. Market interest falls significantly to 3%. Which combination of risk has most materialized for this investor? The answer is going to be B, call and reinvestment risk. This is because with a change in the interest rate, 1, the issuer of the bond can call the bond back, meaning that you have to reinvest it at a lower 3% risk. This is the reinvestment risk. The call risk is, again, the investor can just call the bond back or like finish the payment early before the maturity date. Both of these risks are directly linked to the change in interest rate. Note that the interest rate risk is less relevant here because falling rates would normally cause the price of the bond to rise. How'd you score? If you got a 5 out of 5 SIE exam, here you come. If you got a 3 or 4 out of 5, you have a very good foundation, but you need to review what you missed. If you got a 1 or a 2 out of 5, you got to rewatch the video and try again. Video 5 is going to drop very, very soon, guys. I will have it ready for you guys. And thank you so much for watching. Thank you so much to Anthropic for helping me out with this video. And if you enjoyed, please be sure to like, subscribe, comment down below, and I'll see you guys in the next one. Peace.